Welcome to Hamby's webinar today. We are so very excited. We have Charmaine Brooks as well as her teammate Claire, who from Newrez, who's going to be talking to us today. Thank you all for joining with us. Before we get started, let's go through a little bit of the Hamby updates. So remember, thank you all for being here. And anytime that you want to find out anything about Hamby, all things Hamby, make sure that you are going to hamby.org. That's HAMB.org. And coming up here in our calendar, we have a few different things happening. Super exciting, of course, today. Newrez, their topic is going to be non-QM asset qualifier. They're going to talk about some crypto. It's going to be super awesome. We also have the legislative conference happening with NAM, our national partner, which is going on this weekend. So we'll be looking forward to bringing you guys some updates from that. And then we've got our lenders roundtable at Anaha on April 23rd. So as you guys know, Anaha is one of our favorite locations and venues. It is so beautiful there. Come catch the sunset with us April 23rd for Lenders Roundtable. Get some education as well as some food and drinks and Hamby fun. And then in May, we've got coming forward. We've got another webinar with Dekind. Go ahead, Lisa Kathy.
Dekind is actually not doing May. They want to postpone. Lensure will be doing May now. Sorry about that.
Sorry. Thank you.
The last minute change. I haven't changed the calendar yet. I apologize. It will be me in May.
Yay! So we'll have Lisa Kathy and Lensure in May. And now let's go ahead and take a moment to thank our sponsors. Platinum sponsors for Hamby this year: Freedom Mortgage, The Loan Store, PennyMac, Lendsure, Newrez, Deep Haven, Dekind Lending, and Remen. And then for our gold sponsors, we've got Finance Factors, Angel Oak Mortgage Solutions, Title Guarantee, Acra Lending, Foundation Mortgage Corporation, Advantage Credit, and Home Express. And then, of course, our silver sponsors: Sierra Pacific Wholesale, Logan Finance, Arc Home, and Cardinal Financial. Thank you all for being a part of Hamby's success. We truly appreciate everything that you do for us. Thank you. Now, let's go ahead and introduce Charmaine. We're still waiting for Claire to join us. GoToWebinar has been giving us a little bit of a headache this morning.
What just happened? I just got a message from Claire. She did send me the PowerPoint presentation, so I will be able to display it, but she's still unable to join.
Oh my gosh,
Charmaine,
I just lost the camera. I don't know what's going on. Yeah. Okay.
There you are.
Were you able to pull up the presentation for us?
I do have the presentation, yes, and I will be able to display it.
The only thing is I trying to open it and it doesn't seem to be working for me. So
I have it open, so I'll display it and you can see it, and you can, if you're able to, we can walk through it like that, because Claire's able to join.
That is perfect. That is perfect. We'll just keep rolling ahead.
We'll wing it. We got this. All right, everybody. I will display the PowerPoint presentation for Charmaine, and she will be walking you through it. If she needs help, I will be here to help you as well, Charmaine.
Thank you.
Of course.
Okay, let me share my. Whenever you're ready,
yep, I will share my screen. 1 second.
So, where is? Oh, here. Actually, I might have been able to. Well, I'm trying to pull up the draft, but. So I'm super excited to talk to you about asset qualifier loans and asset-based loans. It's been a big buzz in our industry. Finding ways to make loans work, give us more tools in our toolbox. And I think a lot of lenders have a version of this product, but ours, I think I've noticed when I came into doing non-QM with different lenders, as you guys know, I've worked for a few different lenders. Um, back at Home Point, we did a little bit of non-QM, and then did some non-QM at Remen for a hot minute, and then coming over to Caliber Newrez. I thought they're all kind of the same, but I found out there are differences between one lender's guidelines to another for the exact same product. So it's good to know what those nuances are. So this is one of my favorite loans, the Asset Qualifier, Simplify Your Life. You can go ahead and so we're going to talk today about what the Asset Qualifier is. Unfortunately, Claire Kafori is our non-QM specialist, and she joined us from Rocket Mortgage. Just a little background on Claire. She put this together today. So we're going to just try to break down what is the difference between the asset qualifier and the asset depletion. And I'm going to keep it really short and sweet. So the asset qualifier is when you're just using assets to qualify your borrower only. You're not combining it with other income. You're not like taking someone who just missed a DTI and adding like some assets to make their DTI work. There actually is no DTI for this program. And it's to keep it short, it's such an easy loan. I tell people, everybody knows I'm a VA. I was known as being a VA guru, love VA loans, VA expert, got that my thing. And the VA Earl is one of the easiest loans to do out there because there's no appraisal, there's no asset, there's no income there's no DTI. So I tell people this is the second easiest loan to a VA Earl is using the asset qualifier. Because we still do need appraisals, obviously, depending on your loan amount. And it does go up to $2 million. We have done exceptions to go above 2 million. I've done as high as 2.8 if you had a well-qualified borrower. So in this case, you're going to be looking at borrowers who have at least $500,000. This is post down payment and reserves. So down payment and closing costs, down payment and closing costs, they just have to have at least $500,000 to be able to utilize this product. And all you do is take the assets. If you can go to the next slide, please. Oh, you're on it. So all you do is I'm looking at the wrong screen. So all you do is take the assets. Could you go back? I'm sorry, I was looking at the wrong screen. To you take a breakdown of all their assets, and you can combine multiple assets, as you can see on the screen here. So the side by side, I'm having a really hard time seeing the screen, hun. But let's just stick with when to use asset qualifier. So yeah, the print is just really too tiny for me, and I can't remember all the talking points.
Give me one second. Charmaine, Claire was able to join, so I'm going to add her really quick.
Oh my God, thank you. I needed her just right now because I'm like, I cannot read these. I can't see these slides unless you know what, I just realized I need to match the slide on my screen with what you have up there. Now I can read it.
Okay. Claire, are you able to?
Hi, well, actually, can you hear me?
Yes, we can hear you. Yay.
Yay.
Okay, great.
Right when I figured out what to do to fix the situation. So I am now able to match my screen to what you have on your screen so I can read. But Claire, if you want to jump in and just take over for now, and I'll just jump in later.
Okay, great. Yeah, I can see me, but thank you everyone. Thanks for your patience. So we get started here. So the first one we're going to talk about is asset qualifier. So this is part of our Smart Edge product, and it takes the path of least resistance for our high net worth individuals. It's excellent pricing. It's a no debt ratio loan. So this means that there's no income, there's no employment. It allows us instead to use assets as a qualifying factor. And we say it's high net worth clients. So when we're thinking that 500,000 is like the number we got to think of in our mind as like, one of those like how much assets do you have? Tell me everything, not just what you plan on qualifying for. It even does include retirement accounts, even if you're not of retirement age. And so 500,000 is a minimum for entry to use the asset qualifier. So some of the other scenarios to use or to think about with this product is if they have an eligible business. So like, they're in a cannabis market, or they're just not established for 2 years, or they don't have the 3 years continuance on a W-2 contract job. Maybe they haven't filed income taxes and they are on an extension. We know it's that time of the year. Another one of our partners that does a lot of these is when someone asks for a bridge loan. So as soon as they ask for a bridge loan, they think about this product. Bridge loans, they're expensive. And, if they ask for a bridge loan, then they'll ask like, okay, how much do you have like in assets? Like you may not need to go the bridge loan avenue. Also, it's cutting closing time. So there's those extra steps that are involved with employment verification and transcripts that we don't need to do. So you can skip the line with that. And we do the qualification. We can look at the information up front. And the biggest thing too is, best of all, it offers the same pricing as our full doc Smart Edge product. So similar to jumbo pricing, it's the same. So sometimes we think these products, oh, the pricing's just not even worth looking at, but you got to take another look because it's the same
It's
pricing as like a
priced.
full doc loan.
I just wanted to chime in. It's priced exactly the same as our
Yeah.
regular Smart Edge, which would be a Smart Edge loan using W-2s and pay stubs, or any other type of traditional income. It's priced exactly the same, and sometimes people confuse it because of that. So make sure you look at Smart Edge versus Smart Edge Asset Qualifier. So, and one other thing is, this loan is also useful for primary residences and second homes only. You cannot use it for an investment loan. We have our DSCR product for that.
Yep. Yep. Okay, great. So we'll move on to our other type of like asset income loan, which is asset depletion, which we're usually pretty familiar with. This is also available on Smart Edge and then Smart Self, which is our DSCR loan. It's an option ideal for retirees, self-employed individuals, investors with significant assets. Just turning your accumulated wealth into a qualifying income. Therefore, we can increase conversions and get these loans in the door. So if you need an additional income stream, using a calculation to generate monthly income from a borrower's personal asset, and you don't have that 500,000 up front for asset qualifier, then you can look to this. And one of the benefits too is just assets, they don't have to be solely in the borrower's name. They can be in a joint account. So assets held in a joint account with other individuals, they're considered the borrower's own assets. So that's a great win there.
Yep.
Okay, if we move to the next slide, this is a quick overview, just a side-by-side comparison, so we can note some of the differences between the two. Charmaine mentioned that, it's primary and second home only, not investment, where asset depletion is investment. Also, you can do cash out on asset depletion, where asset qualifier, we're looking forward to just our purchase rate and term, and you do have to have 20% equity or 20% down payment. Where with asset depletion is 10%. And I got a big one on here is our DTI. So DTI with asset qualifier, you see there's 0 DTI, it's no employment, no income, no debt ratio. And with asset depletion, you do have a debt to income ratio max of 50. However, you can go up to 55% with an exception. Loan amounts are great too. So on asset qualifier, we can go up to 2 million, and then with asset depletion, we can go all the way up to 3.5 million. Our finance REO limit is up to 15 on both. And then some of the highlights again with asset qualifier, we mentioned that 500,000 seasoned assets post close to cover. Like we would just want to make sure we're kind of given like a budget that in the next 5 years, the borrower is going to be able to pay their payments, all debt, including other mortgages as well. And then just $2,000 just for personal expenses, like stuff that doesn't go on the credit report, like a cell phone or something like that. And then that's for one borrower. Then for each additional borrower or family member in the home, it increases for $500 with each additional dependent. And then, as always, we're going to use the 60 months amortization calculation. We're going to go through a couple examples on the next couple of slides just so we can see the difference here. If you look on the right with asset depletion, we're going to use the personal asset income stream in addition to the bank statement, 1099 or P&L, and then our calculation on primary and second homes is we take all the assets, investments, and we divide it by 60. And shout out to Charmaine here. She helped get this guideline changed. I think originally we were at 240, like we are for investment. We divide by 240, but she got that down to us to be competitive with 60 months. So thank you, Charmaine.
I wasn't the only AE that was fighting for that, so I can't take all the credit.
Yeah, but you're a big part of it. So we thank you. Everybody does. And then our eligible assets. So they're pretty similar side by side. It's the percentage, it's the haircut that's going to be a little bit of a different amount. So we know that checking, savings, money market, CDs, T-bills, the top bullet there is 100% because those are liquid funds. So we can use all of that. Publicly traded stocks, investment bonds, mutual funds, going to have a little bit more of a haircut on our asset qualifier at 15%. So you can use 85% of the funds on asset qualifier and then 90% of those funds on asset depletion. A big win, a big news for retirement vested accounts. So it doesn't matter if you're of age or not. It's just the difference of the haircut. You can use the funds. So if you're of retirement of age, you can use 85%, and then anything younger, you're at 50%. So if you're at 40 years old, you have a lot of assets, you still can use those vested retirement accounts, but they're a haircut of 50%. If you're on asset depletion, you do have to be of retirement age, and you can use 90%. So most recently, one of the biggest, a big additional asset that we released here at Newrez is crypto. And so crypto is an eligible asset, and of the common ones that you hear is probably, Bitcoin. You can use 50% for both asset qualifier and depletion, and then 90% for more of the stable fiat, US fiat backed stable coins you can use at 90% for both. So it's a big win.
That's a big win.
Yeah, so I always ask, too, when you're asking for, how much, what do you have as far as assets? Someone might not think like crypto is even possible. So it's always one of those things that you can throw in there is, do you have any crypto?
I want to do a shameless plug to remind all the LOs to always get the assets. Ask for assets, even if you don't think you're going to need them. Then you don't have to go back and get them. Or you can see if you might go, oh, wow, this person has $2 million. You can do a loan. You're a lot easier than maybe using their two years tax returns for self-employed or even their 12 months bank statement.
Yeah. It's a lot easier to start out this way than to try and flip it all around. So you do want to make sure, as Charmaine said, get all the assets up front and then see what you need to qualify. But at least what's all on the table for qualifications.
Mm-hmm. Yes.
All right, so what we're seeing on our screen is one of the scenarios using asset qualifier. So we do have a worksheet that's available that does you just plug and play, you input what you need, and it's going to automatically give the percentages used as far as the discount. So any of the haircuts, and then it will give you the totals after the discount. So the scenario that we have that we're looking at is that the borrower is not of retirement age, doesn't have traditional income, but has high net worth. They want to qualify based on assets. So they have $1 million in gross assets. They say, I have $1 million. I really can't document my income. What can you do for me? So, we gathered all the assets were less than 59 and a half. So that's the account type drop down that you're going to use. So between the 401k, IRA, we have crypto, we have 200,000. Again, it's just regular. So we're talking Bitcoin, it's 50%. So again, all the way in the right column, it's going to show you can only use 100,000 of that with a haircut. An investment account, you can use 85% of the 150. So it will break it down for you at 127,500. And then we know checking, savings, cash, this client has 150,000 in it. So we can use 100% of that. And so we see the gross assets is $1 million. After all of the haircuts that are applied, we have 627,500. Okay. So big thing also, I just want to take a look over to the right. We talk about documentation requirements when we're talking about these assets here is, the personal assets have to be seasoned for 6 months, but we don't need 6 months worth of statements. We only need one statement from 6 months ago and one current statement. So, and there's no limit to the number of bank accounts that are used. We are going to look just for consistency. If we see like a big jump from 6 months ago till today, we may be like, oh, okay, we want to make sure there's no gift funds because this program doesn't allow for gift funds. So we want to make sure that it's their own funds that they've earned. Maybe it's a market shift, which we are aware of that, and we're like, yep, that makes sense. That there was an increase from 6 months ago till now. So, less documentation that's needed.
Or a drop, unfortunately, that can happen
Or
too.
a drop, yeah. Now lately,
With we
right?
saw, which we saw recently with the Bitcoin, right?
We did see, yeah, we did see that recently. So we're gonna, yeah, hopefully that will turn around. So,
But for
all
the
right.
asset depletion, that is not the case. It's the asset qualifier only that we need to season for 6 months, but we don't need 6 months worth of statements, just to make it more concise.
Yeah, just one statement 6 months ago and one current statement. So, back to our worksheet here. So we said our net assets were 627, 500. So we're going to take that and then we have to minus any of the reductions that we had. So our cash to close on the scenario.
Or down payment too. So
Yep,
down
is
payment on the
down
purchase.
payment. Yep, is 125,000. So we have to count 100% of that. Something to note with if you have any American Express accounts, you have to take that full payment. In this case, the client didn't have that, but that is just something to note at 100%. And then just all our other monthly liabilities. So we're going to say any in all mortgage payments and the new mortgage payments and new debts. And we're going to times that out by 60. So we want to make sure that there's enough funds over the next 5 years, as we mentioned before. So that's 216,000. If we take then the net assets of 627,500 minus this total reductions of the expenses. So it's a down payment plus your other liabilities over the next 5 years, you get 341,000. So if you take the difference of those two is 286,500. If you divide it by 5 years, you're going to get your residual income, which is here at the bottom. So that will automatically populate for you at 4775. So we just got to make sure that the required residual income, this is a family size of 3, is 3,000. And so we're good.
It's
so
greater than 3,000. So that's just the residual income calculation. But the number, say you only had one borrower though, and it would be 2,000. But
Yep.
But the real, when I'm doing like a quick overview with a broker on this product, I say, you take the 600, the real important calculation, you're taking the 627 less the down payment of 125, which leaves you about 500,000, and then you divide that by 60 months, and that would need to cover all your expenses and leave 2,000, or in this case, $3,000 left over. So I look at it, I usually explain it a different way because we're looking at their assets. And I'm like, okay, so when I'm in the beginning of it, I'm just looking at their assets and taking their $1 million. And for simplicity's sake, say it was all in Bitcoin. And then so you could only use, say, but you had 1.5 million and you take 50% of it, right? And so you'd have 750 less the 125 and then divide it by 60 months. And then that would need to cover all of their expenses so that would mean any mortgages they have, any debts, and you cannot pay off debt to qualify for this program, just to be clear. So
Yeah,
if you
that's a
did
good
need to do,
point.
yeah, so if you do need to do, if that doesn't work, that quick calculation, and you'd want to pay off any debts before you initiated this loan. That was my shameless plug to be proactive
Yeah, no, that's a great point
on
as
it
well. Yeah, thank
and
you for
ahead.
sharing that. Okay. All right, let's roll into, so that's our asset qualifier scenario. If we move to the next slide, we have asset depletion. And so this again gives you a little bit, less of a haircut. So there's a majority more assets that you can use to qualify. We have a couple of retirement accounts in here at 90%. Again, we're going to use some crypto, checking and savings can use as 100%. So our gross assets we came into this transaction was 450,000. After the haircuts was 337,500. So our borrower is of retirement age. They just needed some additional income to qualify. And so we're going to use asset depletion. So the cash to close on this one was 70,000. Monthly accounts was 2,000 and like some other debts and stuff. And then I had some reserves that we needed as well, which was 180,000. So our reductions was 252,000. But eligible assets that we had for income was 85.5. And again, this is a primary home, so we're dividing by 60. So we were able to use 1425 as qualifying income for this loan. Was able to get into the door.
And so a lot of times you can save a conventional loan. These loans might be conventional, and then you can go,
Sure.
oh, I have a debt ratio, I can't get around it, but they have assets. Yeah, versus going conventional. So
Yeah. Yep. So
it's a deal saver.
this definitely is a deal saver for sure. For sure. Okay, great. All right. Next up wasn't really necessarily on the agenda, but it was about condos. We know there's been some action with our agencies. If you move to the next slide, with condos that we just want to call out as well. So just some of this is our differences between warrantable and non-warrantable. Some percentages with our commercial space and non-warrantable is 50% versus warrantable is 35. We have the 60-day delinquent HOA dues is 25 max on non-warrantable, 15 on warrantable. And then just pre-sale units must be sold. We have 30% on non-warrantable versus 50 on must be sold on warrantable. And our insurance deductible is up to 10% on non-warrantable versus up to 5% on warrantable. And I know, Charmaine, you wanted to talk about just we do have our condo team is available to review.
I want to shout out to our condo team. We're actually closing a loan. We're actually approving, hopefully, right now, the park at Ward Village at $1.8 million 2-bedroom purchase that, as you know, is a bulk closing. So one of my brokers was able to finagle into that deal. And so that is something to be aware of. That is a new development, not Fannie and Freddie approved yet. And but yeah, just for our condos, you guys know it's a pain point in Hawaii. But we did recently also just have a win with Craigside on Nuuanu. We actually sent it over to the agencies because they took a $13 million loan out to do a major repair on the drain waste and vent, which is the plumbing in some of these older buildings, and spalling repairs. And we actually sent it to Fannie, and we were able to lend on it, even though they took this big loan out, and the work is underway. It's not finished. So I wanted to share that out there.
Yeah, no, that's great.
And then on to the next slide would be the changes that you guys probably all heard about with the condos that are coming in 2027 with the increase in reserve allocations. Should we go to the next slide? but
Yep,
there was
they
some,
suited. Oop, go back.
but there are
sorry.
some, but there are some positives. There's some silver linings to that dark cloud,
Yeah.
which I'll let Claire cover to make sure you guys are all aware.
Yeah, so one of the things, as Charmaine mentioned, a lot of them are coming next year, which will be here probably before we know it. So you want to make sure you take note of that. But some things were effective immediately, which was the insurance relief. I know we had a lot of loans that would fall into this bottleneck of um, having, instead of the replacement cost, we now allow for the actual cash value roof coverage, which is a big win. Hundreds of condo buildings previously were ineligible for financing, may now qualify, helping borrowers and sellers who were stuck. So I know that personally, I've had a lot of loans brought to me for that. There's a deductible cap now that creates clarity. So capping the per unit master policy deductible at 50,000 actually gives lenders a clear standard and just removes any uncertainty around creating inconsistent lending decisions across the markets. And then there's a waiver expansion, just helps smaller buildings. So projects with 5 to 10 units can now bypass a full project review process under the right conditions. So this just reduces friction for buyers in smaller condo communities. And again, we are promoting our condo team. If you wanted to reach out to them for any updates, we have the email there.
Pre-submission. You can submit condo docs for review to our condo team without even giving us a loan, and we'll review it and see in advance.
Which is a big one.
Lend on the project. Don't forget that.
Yes. All right. And so the latest and greatest, we wanted to also put a plug out. If you move to the next screen, Charmaine, do you want to talk about what we just released here at Newrez?
The doctor's loan. I got so randomly, I was getting emailed and asked, do you guys have a doctor loan? For the last several years, but more recently, last few months. And then guess what? We have the doctor loan, which is a jumbo loan up to 100% financing, loan amounts up to $2 million, primary residence only, and no MI. The minimum LTV on this loan product is 90.01 though, so they can't put more than 10% down for some strange reason. But yeah, we have this product, so there'll be more on that coming. And with that, we can open up to questions or turn it back over to our hosts. Thank you for joining us today.
Yes, thank you. Thank you so much.
Okay. Hi, everybody. Thank you so much for presenting. We're going to open it up for questions. I'm going to see if you come in. I do have a question. I have a question. I'm hearing some. Is that? Are you guys getting feedback? I don't know what's going on. Is that better?
Yeah, I think that's better.
Maybe everybody else mute.
So I had a question on your asset qualifier. It says no DTI on it, right? But you are accounting for all their debts for the next 5 years.
Exactly, yes.
Okay.
So it could be up to you could have 100% DTI. So we just want to make sure that you have enough to cover over the next 5 years. So even if you're above by $1, that would qualify.
Perfect. I just wanted to clarify that because that's the way I understood it. I just want to make sure that was
no, because you still need to meet the residual. So you do need to have.
Well, yes, but you're going to take out. So whatever income they have, you're going to take out whatever assets they have, take out all the debt that they have for the next 5 years, the payments, and then whatever's left over, they have to have so much residual left over.
Yes. Yes, exactly. That's why it's a little different than some other asset-based lending programs. There is no DTI. There's no real DTI.
Perfect. I just wanted to clarify that because that's what I understood too. I just wanted to make sure that everybody else understood. I think that's an excellent program, and thank you so much for sharing that with us.
Thank you.
Anybody else have any questions? Judy, do you have questions? You always have good questions.
You're muted, Judy.
You're muted. You got to unmute yourself first.
It looks like we've got a couple of questions from Danielle M. If you want to read those off.
Oh, she just got a new one. She had one earlier, but it was answered. So she wanted to know if employment was required on the 1003 application. And that was answered, and that is yes.
No, what? Why on what 1003?
Not
Yeah,
on asset
let's let
qualifier.
let's go ahead and
Not-
read the questions and then let Claire and Charmaine answer them for the group.
Okay, so it says, is employment information required on a 1003 application for this, or is this section left blank? But she doesn't clarify what program she's talking about. So Danielle, I believe you're talking about the Asset Qualifier program. If you can please reply if that's correct, and then she can elaborate on that.
If it's the asset qualifier, no, we don't need employment on their 1003. Absolutely not, just the assets.
And
For
then she
asset depletion, yes, well, if they're employed, but you could combine that with other types of income, asset depletion. So if they're retired and it's just retirement, you know, Social Security, and then they use asset depletion, then yeah. So it was just asset depletion, yes, because that one has a DTI calculation. Asset qualifier, no.
Okay, and on that, she's also asked, does the debt include subject mortgage payment? And is it based on qualifying PITIA or note rate on ARM loans?
So the PITIA on asset qualifier, where we're just using the assets, remember, no DTI, we're going to look at every debt on their 1003 on their credit report. So if they have car loans, if they have credit cards, if they have another mortgage for a rental property, and the subject property, we're going to look at all their debts. So if they own a home in California and then they come to Hawaii and they want to buy a $2 million home here as a primary residence, and their total debt is $20,000 a month, but they have $4 million in assets, and you take the hair in their 401k, for example, and you take 85% of that, divide it by 60 months, and that's $60,000, and that more than covers all of their debt, then they're qualified. That's how simple that product actually is. I think we complicated it because we're showing you guys the nitty gritty, but you know what I mean. So, does that answer the question?
I believe so. Danielle, did that answer your question for you? So Danielle follows up, when taking the monthly mortgage payment for subject property purchase, is it based on qualifying rate or note rate?
So we're talking about ARMs. I haven't closed an ARM on that product. I don't know if that would. I have to look at that and get back to you guys. We do offer. Yeah, in our non-QM, we do offer like a 10-year interest only. When qualifying interest only, like for DSCR, we're using the interest only rate. But for ARMs, I haven't really done much ARMs on the non-QM, so I'll have to get back to you. I don't know. I don't even know if that's an viable option, because the only reason why you would do an ARM is if the rate was lower, right? So I don't even know if anyone's using ARMs. Are you guys as LOs? Are you guys doing ARMs on your non-QM loans? You are, Judy. I can't hear you.
We
You're on mute.
are. Yep, the 5-year fixed on like DSCR has been very popular.
Oh, good to know. That's good to know, because I actually we do a lot of DSCR, and I haven't seen anyone use where they were using the ARM. So I need to look at that. Thank you for sharing.
Mhm.
Okay, so I'll have to get back to you guys on that. Kathy, you're muted now too. And Lisa, sorry. I just keep wanting to call you Kathy because it's a dear
Well,
near.
it's
It's like my
common.
mom. I said my mom's name. I can't.
Well, it's Lisa Kathy, so I get called
I
Lisa, I
know.
get called Kathy, I get called everything. So it's
Yeah,
quite all right. I'll answer to it all.
I'm sorry, but it's just for me. It's just the Kathy. So
I totally understand. So I don't see any other questions. Judy, did you have some questions?
Yeah, I've got a question on the appraisal requirements. So for the asset qualifiers, I love these loan amounts up to 2 million and 3.5 on the depletion. Do we require 2 appraisals?
only over $2 million. And I got an exception to do a purchase on the asset qualifier up to $2.8 million. This this borrower had $7 million in his 401k. Can you believe that?
Wow.
I
Yes,
know. Like what? Yeah,
that's
he bought
amazing.
bought a $3.8 million home at Kamehame Ridge, put $1 million down, and we made the exception.
Wow.
So yeah, yeah, I know.
That is awesome. Because
I'm
you,
like, I'm like, how do you do that? Like, can you teach me? It's like, what? What is that?
that is unbelievable. Good for
As what
him.
it was crazy. That was the very first asset depletion. That was the very first asset qualifier loan I did at Newrez. And the only reason why I originated was I didn't realize it was a $2 million cap because we go to 3.5 million on Smart Edge. And I missed it. I'm just being honest here because you know me, I'm a straight shooter. And I submitted the loan and it came to a screeching halt. And I was like, oh, and they're like, well, you can submit an exception. I'm like, okay, let's submit an exception. And we pulled it through. So gotta love that. So I'm like,
That's
don't be
great.
afraid. Don't be afraid to ask for loan amount exceptions when you have a strong borrower.
Mm-hmm.
Yeah.
Well, I am loving these success stories. What other success stories can you share with us, Charmaine?
Um, yeah, like we did well before we had the crypto one. I used this product to do a purchase for this guy who self-employed, but you know his bank statements weren't strong. I think he had a lot of cash business, and he had about 1.2 million in assets, about 200,000 in crypto. He liquidated his crypto and is probably glad he did because it was before it went down.
Yeah,
200,000 and put that down, and we were able to get them into a home with a combination of assets. That one was a tight one, but we got it through. Yeah, and it's just for the right situation, it's a really great loan. You know, and like we have LOs who just love the product. And so say you have a borrower who owns like 5 businesses and they can qualify full doc, but who wants to underwrite that and who wants to submit that loan, and they have millions in the bank and they're like, oh wait a minute, I can just go this route, you know. And that's what it's there for. And
I,
then like saving a loan, the asset depletion to save a loan from a conventional purchase where a nurse, someone who got divorced with 5 kids. She like got a job, but she's hourly, and she didn't have enough continuity of employment, but she had a couple $1 million in assets, and we were able, or maybe 1 million, and we were able to convert that to, you know, additional income and save, and you know, and do a purchase for her and her 5 kids after her divorce, you know. So things like these products are good for, but you got to think outside the box. Yeah, that's it. So
question. Thank you for that. Tell me about the medical professional home loan, because whenever we get out on the street and we're talking to our clients about the medical professional or doctor loan, they always ask us who is included in that bucket. So what are the actual job titles that you'll accept?
they have
Like
to be an actual
chiropractor is always on this.
chiropractor is not on the list. They have
Okay.
to be an actual doctor.
Okay.
So an anesthesiologist, somebody a practicing doctor, and unfortunately, chiropractors are not included in that.
this extends
But
only to medical doctors.
it is. It's like, and they cannot be. We actually have. It's very clear, specific. And we actually sent a lot of marketing out just today, which is why I wanted to include that. But I have the list. Let me see if I can pull it up real quick. It's because they gave us, we just went over it, and everyone was really, it was very specific about what could be included and what could not, what couldn't be. So I think I have it. We just talked about it. Let me see if I can find it.
Yeah, per the slide, it says serving physicians, dentists, and
Oh,
other
yes.
eligible healthcare professionals. So I think that's what I just wanted to flesh out. is
Yeah.
the other eligible healthcare professionals.
I
So
have the
dentist,
list. Do you have it? Okay.
did you find it? Did you know you?
Yes.
Thank you.
Yeah, so medical doctors, so MDs, DOs, DDS, so you had your dental science, and DMD, dental medicine, ophthalmology, which is MD or DO, so our eye
Eye
doctors,
doctors.
Eye doctors.
So
doctor of psychiatrist, pharmacy, doctor of pharmacy, veterinary medicine, so our
Oh,
vets, our animal,
okay.
yeah, caretakers,
yeah.
foot doctors, so podiatric medicine, DPNs, and then CRNAs, so your certified registered nurse
Oh,
anesthetists
and
are
anesthetist, which
included.
is almost
So
like
CRNA.
a nurse practitioner. I'm
Well,
Yeah,
then
surprised they
what
don't.
about
or
nurse practitioners? Are
anesthesiologists.
they
Yeah.
included?
I'm surprised they don't. But they don't include nurse practitioners. It doesn't appear
No,
on here.
no.
Hmm.
But I guess that anesthesiologist is another
It's a lot of
level.
school. Yeah.
Okay,
So,
so a CNRA, but not a regular RA would be included.
Yes.
Okay,
Yeah.
that's a good distinction to know, and definitely I love the parts about the vets.
Yeah.
yeah,
So,
and no nurses. So doctors only.
Yep. Looks
It
like we
seems
got
like.
another question from Danielle. Lisa, Kathy.
well, Danielle, somebody asked, what about veterinarians? We got that answered. So yes to veterinarians. And then Danielle asked, asset qualifier, what percentage of increase in ending balance is eligible without further documentation for asset statement from 6 months ago and current asset statement?
Yeah, so like our vice president of operations just said, like, we take a look to see, if there's some jumps are going to be normal, if it's just something that doesn't make sense, they may say, okay, what was the reason for the increase? But I know it's not anything. No, it's nothing too
There's not a
crazy. If it makes
specific
sense, yeah, then we're
number.
not gonna ask. But if
I
it's
would say,
like,
like if within 10% if it's up or down within 10%, it's not something I think we would look too much at, because
mhm,
if it's in an asset, like if it's a stocks, mutual funds, they're gonna fluctuate. Crypto is
mhm,
gonna fluctuate. If they went from 500,000 to 1 million in that 6 months, maybe they combined assets. Maybe they had, two separate. Maybe they retired from a job where they had a 401k and they had an IRA from a prior. They combined it or moved funds around. Then we might want to see those funds. Where do they? What were the accounts? You'd have to give us. So you could have two separate accounts 6 months ago that are now one account, and then we maybe want to see the transfer, things like that. Or maybe they got an inheritance. Maybe they inherited an IRA.
yeah.
And they
So
were
it would
obtained
make
it.
sense. Yeah. What's the reason, right? It's just mainly we're looking because there's no gift funds allowed. So
Yeah.
just making
But
sure it's
but
not a gift.
but if it's like, if it makes sense, if it went up or down, say they had $1 million 6 months ago, now it's 900,000.
Yeah.
We're just going to use the 900,000, and we're not going to ask really questions about it. Or if it went up by to 1.1 million from 1 million, I haven't seen us ask any questions. Like that's not a crazy amount. Or 1.15. Maybe they had a really good month. Maybe it went up to 1.2.
Yeah.
I don't see us really questioning that. If we know the market's going up or down, or maybe someone's a really good investor, you
Right.
know?
What about
Um,
if you see like a declining trend? Does that come into play anywhere?
No, again, because we're using the lower amount, if it went down, we're using the lower amount and we're taking a haircut from that. So, and then, and those accounts move down too. They move, market moves up and it moves down. So over time, all the financial analysts want to tell you that it's always moving up. In the long run, it always moves up though, right? Inflation.
Exactly. Long-term investment is the name of the game.
But yeah, but feel free to email me at charmaine.brooks@newrez.com. If you have any questions that we didn't cover or you want more information, I can email you directly. Okay.
Perfect.
And yeah, and I did want to set up a time to talk to you, Judy. I wanted you to talk to Claire a little bit about the condo issues we had with the LE Chi when you have
Okay,
time.
cool. We can definitely do that. What about a
Thank you.
phone number, Charmaine? How can they text or call you?
808-497-7072, and I've had the same number for years. So those of you that know me, like, it hasn't changed. I'm easy to find.
Perfect, perfect. Well, it does not look like we have any other questions, and we're almost at the top of the hour here.
Yep.
So thank you, Charmaine, and thank
Thank
you, Claire, for being
Thank
here
you.
with Hamby today. We are so proud and happy to have you as our sponsors and to bring this knowledge to our membership today. So thank you both.
Thank
Oh,
you,
thank you
Judy.
having
And
us.
thank you, Lisa Cathy. We appreciate you so much.
Yes.
Thank you.
Okay.
So
Have
thank
a
you,
great day.
everybody. Have a wonderful day.
Yeah.
Have a great day,
Bye.
everybody.
Thank you.
Bye.
Bye.